Hello everyone, welcome to the virtual class of Standard Costing. In previous 10 sessions, I have discussed variances related to revenue, that is sales variance and sales margin variance. In this session, I would like to start one more area of learning, and it is all about variance related to variable overheads. Before learning variable overheads, it is necessary for you to learn classification of cost. Broadly, we can classify the cost into two parts. First, it's a variable cost, another it's a fixed cost. Variable cost is also referred to as a product cost as it is directly related to production of the goods or services. It is based on number of units produced, and you can say it is a vary with the output. With the output, the cost is going to change. If the output is increased, the cost is also increased, and if the output is decreased, the cost is also decreased. Materials, labor, other direct expenses and variable overheads are referred to as variable cost, while fixed cost is referred to as period cost because it is connected with the time frame. Say for example, rent. It may be per month, per quarter, per annum, whatsoever the terms and conditions decided by the industry and the landlord. Same way, it is based on time. The element of time is most important in determination of the fixed cost. This cost doesn't change with the output, or you can say it is irrespective to the level of output, we need to pay the fixed cost because it is least concerned with the units produced by the company during the specific time frame as far as fixed cost is concerned. And fixed overheads, that will be next part of our learning. Fixed overheads are referred to as fixed cost. So with the basic understanding of the classification of cost, now all of you are clear that the variable overheads are covered under the category of variable cost and it is known as a product cost. This cost is a vary with the level of output and the base of calculation would be number of units produced. Let us understand different variances covered under the category of variable overheads. There are three different variances covered under this category. First, variable overhead cost variance. Second, variable overhead rate or expenses variance. And third, it's a variable overhead efficiency variance. We need to calculate three different variances under variable overheads: cost, rate or expenses, and efficiency. These variances are similar to the variances that we are using at the time of calculation of labor. So, variable overhead cost variance is a replica of labor cost variance. Variable overhead rate variance is a replica of labor rate variance, and variable overhead efficiency variance is similar to the labor efficiency variance. Let us understand all three variances with one practical question. Calculate variable overhead cost variance, variable overhead rate or expenses variance, and variable overhead efficiency variance. Information is provided by the examiner in a tabular form. Particular, budgeted data, actual data. Budgeted output is given as 5,000 units, while actual output is 4,940 units. Budgeted overheads are decided as rupees 25,000, against to which the company has paid 25,100 in actual. Budgeted hours are given per unit, 2 hours per unit, while Actual hours are given in total 9,900 hours. Using these database, we need to calculate all three variances. But before calculation of all three variances, we need to calculate four important items. Without calculation of these four important items, it is not possible for us to use any of the formula related to cost variance, rate variance, or efficiency variance. Let us move to the first item, calculation of budgeted rate. We can calculate budgeted rate using two different expressions, budgeted rate per unit of production and budgeted rate per hour. Let us calculate budgeted rate per unit. Formula: budgeted variable overheads divided by budgeted output. You can check in your question. Budgeted variable overheads are rupees 25,000 and budgeted output is 5,000 units. So we can easily calculate budgeted rate per unit. It is rupees 5 per unit. It means the company has to recover rupees 5 per unit at the time of production for variable overheads. Then calculate budgeted rate per hour. Formula: numerator remains same, budgeted variable overheads divided by budgeted hours. Here, calculation of budgeted hours playing an important role. Let us refer the question. Here, budgeted hours are given per unit and this information is given per unit as 2 hours per unit. Budgeted output of the company is 5,000 units. It means for the manufacturing of 5,000 units mentioned over here at the rate of 2 hours per unit, the company is in need of total budgeted hours 10,000. Here the company has given information to us in such a way so as we need to calculate these 10,000. It may be possible that company may provide you information for these 10,000 in ready-made form. But here it is not given, so we need to calculate using our own ideas. Let us move to next phase of calculation with this particular idea of 10,000. Now, as it is completed in our calculation, let us start the next part. We have completed up to this stage and we are working for this stage. So, as per our calculation, 25,000 rupees budgeted variable overheads, budgeted hours for the output 10,000 that we have decided. So, rupees 2.5 per hour. So, this will be the amount of budgeted rate per hour. Now, after this, we need to calculation of actual rate per hour. We need to calculate only for the time frame, that is per hour. We don't want to calculate anything for per unit. Let us insert the values in the formula. Actual variable overheads divided by actual hours. Move towards next item in the formula. Actual variable overheads are 25,100 and actual number of working hours are given in the question 9,900. So actual rate per hour 2.5353535353. It's a recurring number. If you want 100% perfect answer without any kind of error, it is necessary for you to consider all the numbers. So 2.53535353 per hour. So in this way, we have completed first item, budgeted rate per unit. It's a rupees 5 per unit. Budgeted rate per hour, it is rupees 2.5 per hour, and actual rate per hour 2.53535353. This is recurring. After calculation of these three items, Let us move to fourth and important item. It is all about calculation of standard or budgeted hours for actual output. You can say it is a calculation of revised hours on the basis of the actual output. As per information given to us in budgeted data, we are in need of 2 hours. We are in need of 2 hours. So, we need to spare 2 hours to manufacture 1 unit of production. And we have actually produced 4,940 units. So on the basis of this, we can easily say that we are in need of the hours, and these number of hours playing important role in our entire calculation. It is nothing more than simple cross multiplication. When 1 unit is required, we need to spare 2 hours of labor. So for 4,940 units of manufacturing, how much hours are required to spend? And the answer is 9,880 hours. Now, using all our calculations, we need to prepare the required database for the calculation of variable overhead variances. Using these information, we need to calculate all 3 variances. Now we don't want to check whatever the information given to us in our question. We have modified that information for our requirement. Budgeted rate, on the basis of output, it is rupees 5 per unit. On the basis of time, it is rupees 2.5 per hour. Actual rate 2.535353, recurring number per hour. Budgeted hours 9,880 hours for the output of actual information given to us. So we need to modify that, and actual hours given to us 9,900 hours. Now this information is everything for us. Using this information, we need to calculate all 3 variance. First, variable overhead cost variance. Formula: total standard variable overheads minus total actual variable overheads. How to calculate this? We have 2 different options. We can calculate based on hours. So formula: budgeted hours into budgeted rate minus actual hours into actual rate. Check your question. You will easily find the data. BH into BR minus AH into AR. Check our calculation. Budgeted hours 9,880. Budgeted rate we need to apply per hour rate 2.5. Actual hours 9,900 and actual rate is given as 2.5353 in recurring number. Insert the data. 9,880 hours multiplied by rupees 2.5 minus actual hours 9,900 multiplied by rupees 2.5353 as discussed. So 24,700 is our standard variable overheads, while actual variable overheads are rupees 25,100. This is a matter of expenditure. The expenditure should be 24,700, but we have paid 25,100. Here we have paid rupees 400 more as an expenditure. The situation is adverse. Now, second option for the calculation of variable overhead cost variance. Basic formula remains same, but now we will calculate based on our output. Actual output multiplied by budgeted rate minus actual variable overheads. Let us check the question again. Actual output as per our calculation or as per our question, actual output is given as 4,940 units. Rate rupees 5 per unit. As we are using actual output in units, the rate is also applicable per unit minus actual variable overheads rupees 25,100. 4,940 units multiplied by rupees 5. So 24,700 minus 25,100. So rupees 400 adverse. At this point of calculation, I would like to inform you that these are the alternative methods of calculation. You can calculate based on hours or you can calculate based on output. In both the situation, your final answer remains same. But it is advisable to calculate on both the ground so as you can verify your own answer whether it's correct or not. If using both the methods you are getting same amount, it means you are on the right track. So it's a first signal to you working on right track of the calculation. Second, variable overhead rate or expense variance. Formula: actual hours into bracket budgeted rate minus actual rate. It is similar to the sales quantity variance, price variance. Actual quantity, budgeted price minus actual price. Similar to that, we need to use hours over here. So actual hours into bracket budgeted rate minus actual rate. Now move to the calculation. Actual hours 9,900, budgeted rate rupees 2.5 per hour, because we need to multiply these items with the hours, minus actual rate 2.535353. Insert the figure in the question. 9,900 hours into bracket 2.5 per hour minus 2.535353, recurring in nature up to your calculator is saying yes. So the amount of difference is rupees 350 and it is referred to as adverse. Why it is adverse? We need to think twice. We have decided to pay rupees 2.5 per hour, but actually we have paid 2.53535353 to our workforce. Here we have paid more amount to our workforce. Additional payment resulting into additional cost, and this additional cost decreases amount of profit. So it is affected to profit adversely. That is why it is adverse. With this, our second variance comes to an end. Third and last, variable overhead efficiency variance. Budgeted rate into bracket budgeted hours minus actual hours. It is similar to the volume, because in a volume, budgeted price, budgeted quantity minus actual quantity. Here price is replaced by rate and quantity is replaced by hours, because we are working with the human hours. Now check the question. Budgeted rate rupees 2.5 per hour. Budgeted hours 9,880 and actual hours 9,900. Using this, insert the formula 2.5 per hour into bracket 9,880 hours minus 9,900 hours. Difference is rupees 50. it is adverse. Why it is adverse? Just try to understand. We have to complete a task in 9880 hours. We have completed our task, but we have taken more time of 20 hours because we have completed our task in 9900 hours. When we are taking 20 hours more in order to complete our work, we need to pay more wages or more expenses to our workforce. When we are paying more expenses to our workforce, our total cost goes up and ultimately it affects to our profit adversely. Or you can say, instead of 9880 hours, we have completed our work in 9900 hours. So we have spent 20 hours more on this work. When we are spending more hours than that of required, it is known as less efficiency. So again, less efficient work is also part of adversities. So it is adverse. Same as earlier variances, you can check or you can cross check your result. Variable overhead cost variance rupees 400 adverse. Variable overhead rate variance rupees 350 adverse, and variable overhead efficiency variance rupees 50 adverse. In variable overhead variances part, you need to learn only these three items, but you need to calculate so many things before application of the formula. I hope everybody is clear with the calculation. Thank you. Keep watching next sessions. God bless you. Keep learning, keep growing.